Welcome to Smart Investing, the podcast where we simplify complex financial concepts for your risk investment journey. And I'm Shahzaib Khan, and today we'll discuss one of the most important topic for investors: analyzing risk in investment decision. Risk is inevitable part of investing, but understanding how to identify, assess, and manage it can make all the difference in achieving your financial goals. So let's get started by discussing the essential aspect of risk analysis. So let's dive in. What is risk in investing? Risk is uncertainty around the future returns of an investment. Simply put, it is the possible of earning less than expected or losing your investment. There are several types of risk to consider. The first is market risk. The risk losses due to market fluctuation. For example, during economic downturn, stock price often drops. The economic 2008 situation was one of the market risk. Second is credit risk. The possibility that a borrower or a bond issuer fails to meet their obligations. Third is liquidity risk. The difficulty of selling an asset quickly without impacting its price. Fourth is inflation risk. Over time, inflation can erode the purchasing power of your return, especially for your fixed income investment like bonds. Fifth is specific risk, also known as unsystematic risk. This is tied to individual companies or industries and can be mitigated through diversification. Recognizing this risk is the first step in managing them. The risk return trade off. Now let's talk how risk impact investment returns. Higher risk generally comes with higher potential rewards. For example, stocks are riskier than bonds, but often deliver better returns over the long terms. To understand, the investor use tools like Standard Deviation. This indicate how much an investment returns can vary over time. A higher standard deviations mean greater volatility. Beta. This measure an asset's volatility compared to the overall market. A beta greater than 1 indicates greater volatility, higher volatility, and a beta less than 1 mean stability. Value at risk. This estimates the potential maximum loss of an investment portfolio for a specific time frame and confidence level. These tools can help risk and create decision making. Managing risk effectively. Managing risk is just as important as identifying it. Here are a few strategies to keep in your mind. The first is diversification. Spread investment across different asset classes, industries, or regions to reduce the impact of any single loss. Asset classification. Balance your portfolio based on your risk tolerance and investment goals. For example, younger investors might lean toward equities, while older investors may focus on bonds. Hedging. Use financial instruments like options or futures to protect against adverse price movement. Sensitivity analysis and scenario analysis. Sensitivity analysis examines how changes in variables such as interest rate or cash flow affect outcome. Scenario analysis considers multiple hypothetical situations to catch potential risk opportunities. By using these techniques, you can align your investment with your financial objective while mitigating unnecessary risks. Real world scenario and takeaways. Let's consider a practical example. Imagine you're investing in real estate. To manage risk, you could use sensitivity analysis in Excel to test how changes in interest rates or constructions delay impact your return. This help you to make informed decision based on various outcomes. Or if you're evaluating a startup, assessing its beta and diversifying your portfolio can balance the high risk or of a single investment. That's all for today's episode of Smart Investing Insight. Thank you for tuning in. Remember, every risk is a step toward reward when managed wisely. Until next time, invest smart and stay inspired.